now for news from the eNCA. Mandy, Devan Murugan joining me in studio. Good evening, Devan. And you want to focus on important tax changes that Treasury has agreed to make. Tell us more.
Yes, indeed. Some very important changes. In fact, the Treasury's agreement to make those amendments, Sally, follows public hearings and engagements with stakeholders now, from tax involving immigration to whether companies should receive a tax benefit if they dish out bursaries. I want to bring in Head of Tax Policy at PwC, Mandy. Kyle, thanks very much indeed for talking to us. I think there was a lot of uncertainty ahead of these intended amendments. The big one was immigrants who needed access to their retirement fund savings when in another country. Now, they were not allowed to withdraw for a 3-year period. What's the difference now? And give us the context.
Well, evening, Devan, and evening to the viewers. Yes, so certainly the current dispensation around exchange control is essentially an approval system that is in place. If you want to immigrate and so on, you need to get the and immigrate formally from an exchange control perspective. You essentially need to get the approval of the exchange control authorities insofar as that's concerned. And what that allows you to do is access your retirement funds. It's one of the few times that you're actually allowed to access retirement funds outside of actually retiring itself. So when you formally immigrate, that gives you the ability to access those funds in terms of the current dispensation. What the proposal is to change it as they move towards modernising that exchange control system and move towards a cash or capital flow management system, rather. One of the proposals that they need to deal with is that the concept of immigration from an exchange control perspective will be done away with and will be phased out over a period of time. So they need to change the current rules that exist insofar as the ability to access those retirement funds on immigration is concerned. And the proposal that is on the table in terms of the draft bill is that immigrants would only be able to access those retirement funds once they have been non-tax resident from a South African perspective for a period of 3 years, which is a significant difference from the current dispensation, as you'd imagine.
And that's crucial, Kyle, I would imagine, because the rand exchange rate could have influenced their earnings when they were in, let's assume, another country for an extended period. Their hands would essentially be tied.
That's quite correct. And to add to that, immigrants often need to access those retirement funds in order to set themselves up in another country. Given how weak the rand is and the relatively poor purchasing power of the rand, it very often happens that if you want to go and buy a house or anything like that in another country, you really do need access to that capital that is sitting in retirement funds in order to effectively be able to set yourself up, or at least to make your life a little easier when you immigrate.
Carl, so time is against us, but I want to get your thoughts on this next question. The Government Economic Recovery Plan, it's due on Thursday. A lot of anticipation ahead of Cyril Ramaphosa's announcement this week on Thursday. And we hear reports today that we could see some proposed tax changes. This could be anything from a fuel levy to estate taxes. A lot of people would be saying that's the last thing we need right now. What's your take?
I tend to agree with you, Devan. So certainly in terms of the fuel taxes, if we need to raise additional tax revenues, well, that is a relatively efficient way of doing so. It is one of the least economically distorting mechanisms to raise taxes and to raise relatively significant amounts of taxes. Estate taxes, well, they sound very nice on paper, but they don't raise a hell of a lot of revenue and so on. But if you're looking to improve the progressivity of the tax system, that's not necessarily a bad thing to look at as well. The other one was a solidarity tax, which is, when you cut to the chase, is just an increase of personal income taxes on hard net income earners. Frankly speaking, I would be opposed to anything like that. Our level of taxation from a personal income tax perspective is already at record levels, and then again on a much narrower tax base than it was a number of years ago. And if you think about it, a few years back we had an increase in the maximum marginal tax rate from 41 to 45%. Well, frankly, in the current circumstances of where this country is, that already is effectively a solidarity tax, if you think about it in those terms. So it remains to be seen where we go. I would much rather see, if they want additional tax revenues, that we improve the effectiveness and efficiency of SARS in terms of collecting taxes and closing the very significant tax gap that we currently have.
And that's exactly what the Tax Commissioner, or the SARS Commissioner, Edward Kieswetter, wants. Mandy, the Head of Tax at PwC, thanks very much indeed.